What's up everybody, welcome to the Stocks channel. My name is Cory, and Friday in the stock market we saw another high volume buying day with very bullish engulfing candles across the board. Are the bulls getting ready to run? First up, let's take a look at the S&P500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so Friday SPY was up 2.43%, and again look down here at the volume and we now have two very bullish engulfing candles on very high volume. So we are definitely seeing a shift in the market, and there is still the possibility we are at very critical levels because remember, we are getting this bounce off of the 200 weekly simple moving average. I've told you this before and I'll tell you again, you are still very likely in a secular bull market while price action in the S&P 500 is above a positively sloping 200 weekly simple moving average. There's nothing subjective about that, it's 100% objective, and right now we are looking at price action that is getting a very strong bounce off of that level. So it doesn't matter what anybody says, we are following what the charts say, and right now the charts are telling you that they are more bullish than bearish in the very near term, but obviously in the medium and long term we are still in a bear market that is still a downtrend. So for this reason, I think it is a very simple market, because you need to be bullish as long as we are above this rising 20 simple moving average, because that is the very near term support the bulls need to defend. That is a moving target, but right now on SPY that is right around 366. But as you can tell if you zoom in, there is a very slight uptick in the slope of the shorter term moving averages, which means the bulls are in control in the short term. Now the bears are just barely higher, so there is going to be a very large battle coming up next week. And the first battle is going to be at this previous daily high at SPY 378 and right around that negatively sloping 50 EMA at 380. So there's going to be very strong resistance on SPY from about 378 to 380. And then of course the big bad bear is sitting right up there at 390. And I do think we are still in a bear market as long as SPY is below 390. If the bulls can push all the way through SPY 390, we are very likely going to start considering the fact that we could be entering a bull trend. So we are in a bear trend as long as SPY is below, let's call it 380. But as soon as SPY breaks above 380, then we're going to be looking for that epic battle where the big bear is waiting at 390. And if the bulls push through 390, we are going to be looking for a much more bullish scenario. But while SPY is below 390, we are still looking for the bear market scenario of lower highs and lower lows. So yes, we have high volume buying days, and yes, we have bullish engulfing candles, but we need the bulls to continue to prove it because we are in a bear market. The ball is in the court of the bulls to prove everything because the bears already have the advantage of the trend and the very weak price action. So the bulls need to push through the resistance, otherwise the bears are going to take over control yet again, and then we could still push down for another lower low by the time we get to midterms at the end of the month. Keep in mind, midterm election volatility is usually a very real thing in the markets based on seasonality, but I always suggest you follow price action over everything, and you can be aware of seasonality, but don't let it make you overly biased because right now in the short term we are looking bullish. On the Nasdaq 100 triple Qs, we were up 2.34% on Friday, and again another very high volume bullish engulfing candle, and we are getting the bull breakout on the triple Qs above the resistance trend line. The resistance trend line on Friday required a break above 273, and we closed all the way above 275. So that is a very strong bull breakout, and as you could tell, the 20 simple moving average is no longer negatively sloping. So there is going to be very critical support on the triple Qs right here, right around 271, and the previous lows right around 267. So as long as the triple Qs are above 267, I do think the bulls are still in control in the short term. Now, as soon as we lose that support, all bets are off because we are in the bear market. So this could be another lower high before the next lower low, but that is going to require the price action to show us weakness by breaking below 267. So we're bullish in the short term until we lose this critical support zone. And the next area the bears are going to start showing up is going to be this gap fill right around 280, and then the daily resistance at 282 and 284. If the bulls manage to break above 284, the big bad bear is still waiting up there at the critical risk level, which is 293, and above triple Q's levels of 293 will instantly need to start getting more bullish on this market. So just a summary, we are still in a bear market and we are looking for the bears to show up at all of this resistance, but we're not looking for any major solid rejections until we either break below 267 or get to the critical risk level at 293, Whichever comes first, just be prepared for either of them. In the short term, we're in the uptrend until we lose support at 267, and below 267, we will be looking for a retest of the lows or the next leg lower. On the Dow Jones DIA ETF, we were up 2.5% on Friday, and the Dow Jones is showing follow through with our double bottom, which we have been monitoring, and I have been telling you that is a very bullish formation because we did get the confirmation of the breakout above the neckline, and we did get 2 consecutive closes above that neckline. By the third day above the neckline, we had the critical test of that support at 303, and as you can tell, the bulls took over and had a very bullish engulfing candle off of that support level, and that is why you saw high volume buying on Friday, and we're almost back up to the critical risk level at 312. So it really goes without saying that the Dow Jones is leading the way because it never made a lower low. It has the double bottom breakout, which takes its price target all the way up to 320 on the break above 312. Now 312 is a very critical risk level, so there should be a picture of a bear there, but you will want to wait for confirmation of a break above that level before you consider the fact that we're going to fully hit the price target at 320 or fully close the gap around 323. So critical support in the Dow Jones remains 303, so you need to be bullish as long as the Dow Jones is above that neckline breakout. On the Russell 2000 IWM ETF, we were up 2.17% on Friday, and we did get the bounce off of the 20 simple moving average, which is at level at 169, and the 20 simple moving average also now has a positive slope on the second bullish breakout above the resistance trend line, which is telling us IWM is starting to look a lot stronger, and it's on extremely high volume. So you're getting these high volume bullish looking candles. Even though the IWM is not bullish engulfing, it is still very bullish looking. Now IWM has the potential of a double bottom breakout, which will require a break above the neckline at 176 and the critical risk level at 178. So by far we're looking for bears to show up at those levels, but if the bulls push through resistance, it's going to be a very quick trip up to fill the gap at 188 because that will be a double bottom breakout. Critical risk will be the support level right here at 169 and 167. And if the bears push through all of that support, we're looking for a retest of the lows, but more than likely another leg lower at 159.5. On the ARKK ETF, we were up 1.79% on Friday, and ARKK continues to look weak because we are still below the negatively sloping 20 simple moving average and the resistance trend line of resistance at 36. While ARKK is below all of this resistance, there is absolutely no reason to be bullish. But if you do want to be a contrarian and you want to try to buy low, of course, these are your levels you're going to do so at, with the critical risk level being a breakdown below 33.7. Bulls will start to run if we can get back over about 37.5 and then the previous daily high at 41. On the VIX, we were down 0.97% on Friday, so we see the second day in a row of the VIX closing back down below 30, so the bulls will need to push the VIX all the way back down below 28 next. This is still a higher low until the bulls can break the VIX down below 28, so that is by far going to be the bullish price action we're waiting for in the VIX. Now in the short term, we could see the VIX spike up to retest the low 30s, so you will want to continue to expect a very volatile market while the VIX is this elevated. And do keep in mind, I constantly remind you, the VIX volatility does mean the market could be volatile in both directions. So do not assume a high VIX means the market has to go lower. On Bitcoin, we're still stuck in the trading range between 19,000 and 20,000, so we're not going to have any major updates here. On a bear breakdown below support, we're looking for the next leg lower at 17,000, and on a bull breakout above the resistance, we're looking for the next leg higher at 22,000. On Amazon, we were up 3.53% on Friday, and we did see a slight uptick in volume, and we're back above the 20 simple moving average, and we're back up to critical resistance at 120. The break above 120 to about 121 will be the bull breakout for the gap fill at 126. And if we see a rejection from this resistance, look for a retest of support at 115 and 113. On Microsoft stock, we had a very bullish day on Friday, going up 2.53% all the way back up to the resistance at 242 and the bull breakout above the resistance trend line. If we can get the break above 242, look for the next strong resistance at 249 and then 252. And if we get rejected from resistance, you're looking for support at 237 and 233. On Nvidia stock, we were up 2.23%, and we did see a bull breakout above the resistance trend line for the second day in a row and a close above the resistance right around 122. From here, we should run back up to retest resistance around 132 to 135, and above 135, we're looking for the gap fills in the 140s. A rejection from resistance should take us back down to support at 122 and then 115. On Tesla stock, we were up 3.45% on Friday, and we did get that bounce off the previous daily closing low right around 205, and we're right back up to the 5 EMA, but overall price action is still very weak and they still have a very strong bear trend. On a break below 209, you're instantly getting more risk off, but we do have the previous daily closing low at 205 that you can also use as a risk level. If we continue to break down, the next leg lower is very likely going to take us down for a test of 186.5. And if we continue higher, you're looking for a break above about 222 to send us to our price targets at 231 and 238. On Apple stock, we were up 2.71% on Friday, and Apple has another bullish looking candle right at resistance at 147 on increasing volume, so we are looking bullish as long as this is the case. Apple's critical resistance is going to be 147 and 150, so you're getting more bullish as we continue to go higher and blast through resistance levels. Downside support to consider will be around 146 and the 20 simple moving average at 144. The financial sector was up nearly 3% on Friday, back up to the 50 EMA, so we're going to have a trading range between the 50 EMA and the 20 simple moving average until we either get a bull breakout above 33 or a bearish breakdown back down below 31. The industrials were up 2.75%, very close to resistance at 89. And you need to remember this is a very critical resistance area, which is our resistance level and our resistance trend line. The healthcare sector was up 2.25% on Friday, and we're back over the 5 EMA. So if we can get a second day in a row back over this level and turn it into support, that is going to be an incredibly bullish development. The energy sector was up 2.89% on Friday, and we are getting that break above 87, and we are starting to push on the gap close, which is just below 88. That is instantly going to act as resistance, and it's also our previous support trend line, so look for strong resistance between $87 and $90 on energy. So jumping back over to the S&P 500, in the short term, the bulls are showing with high volume buying and a short-term uptrend that they are still out there and they are willing to buy at these levels. So do not completely ignore that, because that is following price action. And even if you continue to be bearish in the short term, you have to respect the fact that the bulls are pushing. We continue to have a lot of earnings reports up, and we do have big tech right around the corner. And of course, there's going to be plenty of catalysts for this market, and it's going to remain volatile while the VIX is this elevated. So as I always tell you, know all of the scenarios and then let the price action guide you, and make sure your trade plan is always using proper risk management. You need to be patient, disciplined, and have great risk management to be a profitable trader. So continue to practice that, and always make sure that you have a plan, because if you don't have a plan, trading will get very emotional. And if it gets emotional, you are very likely going to panic when you should be acting. Also, don't forget I have Bank Trade Alert, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. If you want to learn more about Bank or want to subscribe, you can click on the link in the description of this video. If you're looking to become a better price action trader, consider joining the Stocks Channel Trading Discord community, where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.